Hey everybody, I'm glad to be here today. My name is Brent Moores, and it's time for managing your options portfolio. Today, I want to talk about how to make sure your portfolio matches what your forecast is. And to do that, we're going to talk about beta and beta weighting and some fun stuff like that, in addition to some other management we'll do in the portfolio as well. I'm just glad you're here. And I'm also glad to be joined by Scott Thompson, who's helping us out in the chat here today. Appreciate Scott. You can follow me on X if you like. I post content throughout the week on X that I think you may find of interest. Check it out. At Brent Moore CS is my X handle here. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. The paper money application, which we'll be going through today, which I'll be using today, the thinkorswim desktop software, is for educational purposes only. All investing involves risk, including the risk loss of principal here. And, for the sake of simplicity, I'm not going to be necessarily factoring commissions in all the trades we look at, but just realize they are a real thing. And past performance of any security or strategy does not guarantee future results or success. And the paper money virtual trading application will not assign short option positions early. That is different than real life. It certainly, you are susceptible to early assignment risk there on options. So what I want to do is I want to start with looking at the market, and then I want to talk about beta weighting, delta. We'll throw in a trade probably to try and maybe tweak some of those things that we're going to talk about here. And we'll also talk about money management. Or portfolio management, position management. And so we've got a full agenda here today. So let's get to it here. Let me head on over to the thinkorswim platform. I think it starts, when we talk about making your portfolio match your forecast, you got to come up with your forecast. And of course, there's certainly uncertainty in the forecast, but let's look at the S&P 500 right now and what it's been doing. I don't know where things are going to turn around, but what I would say is this, is we've been in a downtrend. You can see I kind of have this purplish, I'm marking over it with the yellow line here, but you have this purplish trend line that we have not broken. We have potential resistance level, which was kind of the high of that big green day. Well, it matches up there, matches up with our lows. I would consider that to be a significant resistance. If we break above that, that would be a pretty positive sign for the market, I think. Right now, we're not seeing that. In fact, it looks like we've gone up, and I'm bouncing down from that, okay, right now. So if you're just looking from the perspective of trend, things are not real strong right now. And they haven't been strong for a little while. And so because of that, we've taken a little bit more of a bearish posture in this portfolio. I'm going to show you how we can tell using some of the metrics I'm going to use here in just a little bit. But we have the trades we've done in this class and in my other classes probably more bearish than bullish of late for this very reason, because, you've heard the saying likely, the trend is your friend, and we've been trying to invest with the trend. But we also do examples of bullish and bearish, and we'll see what we got here. So that's what we're going to do here. Now, so that's the market. Now, you can look at the NASDAQ, you can look at the Russell. They're not going to look that dissimilar, to be very honest. So I'm not going to take our time to do that. But what I want to talk about is a concept to start called beta. I think a lot of you have probably heard of beta. Some of you may not know what beta is. Beta is basically how much a stock or a portfolio moves in relationship to the S&P 500. In the case of a stock, the measure of beta is, you can find it on the thinkorswim platform. You may need to expand it out on the trade page. Just click right here. And mine says fast beta. It's just a shorter term beta. Yours may say beta. You can always change that up in the gear up here. Go to application settings and Let's see. It's on one of these calculations, beta calculation method, okay? The standard beta goes back 5 years, which is a little longer, so I have fast beta, but you can do whatever you want on there. Now, the benchmark for beta, I said we're comparing it compared to the S&P 500. Well, here we're showing as a 1. Well, this is the S&P 500 index. 1 is your benchmark. 1.0 is your benchmark. Beta that's higher than 1 indicates that that stock, or if you're looking at a portfolio, that portfolio is moving, tends to move more than the S&P 500. So when the S&P 500 goes up, it tends to go up more. When the S&P 500 goes down, it tends to go down more. A beta of 2 would indicate kind of like a 2% move up or down as compared to a normal 1% move on the S&P 500. So if you have a company, if you have companies with high betas, when things are going well, when the S&P 500 is going well, it's going to tend to outperform and do better than the S&P 500. Now, that's not true that's no guarantee on any individual stock, of course. You may have a high beta, it may go opposite the S&P 500. Similarly, when the market goes down, if the market's going down and you have a high beta, it's going to tend to underperform and do worse than the S&P 500. Let me ask you your experience. Have you ever been, maybe you're cruising around online, you're looking at your social media, and you see somebody in the middle of a bull market bragging about their investment returns? Let me ask you this question. Is it possible? Is it possible that maybe they're not brilliant stock pickers? Maybe they have a high beta portfolio in a bullish market, and that's why they're outperforming the S&P 500. Okay? Well, things have changed this year because the market has been going down, at least the last couple months. And so you kind of, you get the negative consequences of that beta, okay? So in cases, how is this different from volatility? This is a volatility measure, okay? There's different volatility measures. Don't confuse this with implied volatilities, which are an expectation of future volatility, like the VIX, if we're looking at that. This is backward looking, okay? This is backward looking, this beta. So that's the first thing I want you to do. Let's just look at a couple examples here on this. And let me get out of that. And so I'm going to put in a stock. Let's put in NVIDIA, okay? This is a stock I think you all know. What do you expect the beta to be on NVIDIA, okay? Why don't you type that in? And while you're typing that in, let me just mention this. We have a survey link in the chat. We always appreciate your feedback, folks. I read those surveys back. I read those responses you give. And if there's a subject you want me to cover, put those in there. I mean, I can't make absolute guarantees on everything, but I do try and cover any topics that you want to do. And George said, greater than 2, NVIDIA, high beta. Yeah. So, you know, you guys can get a sense for this in the market. So here's NVIDIA. I'm going to pull it up here. And beta, 2.1, okay? So yeah, Scott said above 1 for sure. Yeah, because it's tech stocks have a reputation for a high beta, okay? That's what we got. What about, let's go to the other extreme. Think about what kinds of companies would have a lower beta, okay, typically. Now, we can talk about industry groups or sectors, and every stock in a sector isn't going to exactly match that sector, but I was thinking of this one. I was thinking of Coke, okay? Here's Coke. This is kind of a old traditional, more of a staple type company. Look at your beta's low, okay? Probably not expect. So when the market's going up, Coke is likely to underperform the market. When the market's going down, it's likely to outperform the market, okay? That's Coke, okay? Well, what's Someone brought up Procter & Gamble. Let's take a look at Procter & Gamble. Procter & Gamble is a staple. Staples in general are going to have lower beta. Okay. I don't want to spend too much time on this because I've got a lot I got to get to, but let's just throw in 3M. Okay. What's 3M? Beta's a little bit higher. It's pretty average though. So we'd expect it to move a little bit closer in terms of like volatility measures, closer to the S&P 500. Now, I want you to just kind of put that in your mind right now, that beta discussion, because we're going to come back to that discussion. But I also want to talk about a different measure. And that different measure is delta. Delta tells us how much option, or a stock for that matter, I guess, is going to move in relationship to a $1 move in the stock price. So let's say we'll take Delta Airlines. I have Delta Airlines here. And I have 150 shares of Delta. If Delta goes up $1, how much are we likely to make on Delta? Because I have 150 shares, $150. If Delta goes down $2, we're likely to lose about $300 on Delta because on Delta Airlines, I probably not a good example because the name of the company is the same as the Greek that we're using there, but probably lose about $300 there. Okay, if we were to go down $2 on Delta. We can move that over to options too. Okay, we can move that over to options too. Here's Intel. We have Intel. This is a positive delta trade currently. Means if the underlying stock goes up about $1, and there's no guarantees on this, of course, we'd expect to make about $14 on this trade, this option trade. Okay, if Intel goes down $1, we'd expect to lose about $14 on that. Now, Delta can change. In fact, as we're talking, I just saw it move. Delta can change over time. Delta can change as the stock changes too. Okay, so Delta is that measure, and it can give us an idea of how much. Whether we're bullish or bearish. Am I bullish on Intel? Yeah, I'm a little bullish on Intel. Okay. Let's go to some other. Look, we got some single options here. Am I bullish on NVIDIA? No, I have a bearish trade on NVIDIA here. Okay. I think it's a long put. Let's see what we got. Yeah, I've got a long put on NVIDIA. Okay. It's a bearish trade. How do we know that? My delta is negative. So delta tells us bullish or bearish and the extent it's with which it is bullish or bearish. And this can be helpful in looking at these individual positions. We can also look at this in terms of a portfolio. Okay, you can look at your subtotals. Now, to make it a little easier, because I have this all grouped, let's ungroup it for a sec. You could ungroup your positions. Go to this little 3-line menu up here. That's the wrong one. I clicked on the wrong one. Hold on. What am I doing? There we go. I think it's this 3-line menu. I'm going to uncheck show groups. Okay. All my positions are not grouped right now. And now I can see a total. Now there's a problem with this total right here, this delta total. I can see, oh, this looks very bullish, 283. But everything's different. When CNP goes up, it doesn't mean that the market is going up, okay? When NVIDIA is going up, it's different than the S&P 500 going up. And so these are all like comparing. This is how much Bank of New York Mellon is going to move in comparison to how much the trade is going to move in comparison to Bank of New York Mellon, which is great if I'm looking at this individual stocks. But if I want to value my portfolio, remember our goal today is to match our portfolio with our forecast. This isn't very helpful for our whole portfolio on the whole portfolio level. So what we're going to do is we're going to compare each of these to our portfolio by doing something called beta weighting. When I beta weight, I'm going to beta weight to the S&P 500. Now what I can see at my total is, oh, overall on my portfolio, when the S&P 5, this tells me how much my portfolio is likely to go up or down compared to a move in the S&P 500. Now, a 1-point move in the S&P 500 isn't much, right? If I go to SPX here, it is 50, it's 50 at 5,300. I mean, today we're down 1%, about a 63-point move here on this. What this is telling me, a 63-point move with a delta of, I'm going to say -1 here. That would say we're looking to 63, about a $63 move on that. Multiply your delta, your total delta for your whole portfolio times whatever your expected move is, and that'll give you a sense. In this case, it's negative. So if the portfolio if the markets go down, it's actually going to benefit us. All right. Now, 0.91 is not a big delta. It's not for, I got a sizable portfolio here. That's a pretty, we're going to call that pretty delta neutral is what I'd call that right now. Pretty delta neutral. And under many trading conditions, traders, investors often will keep a delta positive because the idea is, hey, if the market goes up in general over time, and that's no guarantee for the future, but over history, the market has kind of moved up over time, then people like to keep a generally positive portfolio. Our portfolio has actually shifted this overall to negative. I would say that's actually pretty exceptional for this portfolio that I've taught in my classes. Usually in my classes, I'm keeping a positive delta for the simple reason that the expectation is over time, the portfolio is going to go up, but these aren't normal times. These are kind of special times. But this is the crux of it. I said at the beginning of class, what I want to do is I want to match the portfolio to your forecast. And this isn't for this portfolio. I want you to ask yourself, does your portfolio match your forecast? Okay. Does your portfolio match your forecast? What do you want your delta to be? Think about that from a risk perspective. Let's say the portfolio goes down, let's say the S&P 500 goes down 5%. You can calculate your risk from that. In this case, I have a negative delta, but let's say your delta to the SPX is, we'll say $8, okay? Your delta is 8. Let's just give that example here. And the market goes down 10%. Well, the SPX at 5,300, 10% is going to be 530. 530 times 8 would be about $4,200. We'd be looking at approximately, again, this is just an estimation, an approximate, I realize my handwriting is mangled there, that's supposed to say 4,200, approximately a $4,200 loss in your portfolio if you had a positive delta for your portfolio beta weighted to the SPX. See how I did the math there on that? I took the delta, multiplied it by our expected move, and that's how I came up with that. Okay, you should probably consider that for your portfolio. Is a 10% move down unreasonable? No, I don't. We're down about 10% right now this year on the SPX, by the way. We were down more. Right now, we're down about 10% roughly on the SPX for the year. And we're down more than that from the highs, I think, from the highs in February. So consider it that way. Now, George brought something up in the chat. And I love, those of you who are live can see the chat, and I appreciate that. You can see that survey link in the chat as well. George said short term, he has one forecast. Long term, he has a different forecast. That's a good point. Sometimes your forecast for the short term is not going to necessarily match your forecast for the long term. And so you got to kind of balance those things. You may shift this. I may shift this up a little bit. I may not want a screamingly bullish portfolio right now, but for the long term, maybe I do want that delta a little positive. So let's say we want to shift that. How can we shift that? Well, there's different things we can add. You can make that more bullish. How do you make it more bullish? Well, one way is you could take off negative delta trades. If I took this NVIDIA trade off, I would that would subtract 220 from my total. Well, excuse me, add back, because we're subtracting the negative. So we'd actually add 220 to the portfolio. That would change it. That's one way to change your delta. Take positions off. Another trade is to add on positions. Long stock, that would add on delta. Probably, yeah. I mean, unless it happened to be negatively correlated to the S&P 500, which would be unlikely. Option trades, well, what would add delta? A long call would add delta, right? Short put vertical would add delta. Depending on other trades, we can, calendars could, depending, they're more neutral. But long calls would typically add a lot of delta. Long stock would tend to add a lot of delta. Long puts would tend to subtract quite a bit of delta. Well, this is an options class, so I'm not just going to add on long stock here. What if we did a synthetic instead to add on a little bit? I don't want to make this, like I said, a massively bullish portfolio right now, given the market forecast that we looked at, okay? There are other ways to add delta. I'm not going to talk about futures trading, but some people will use futures trading in this class to do that. Index options. Okay, if I did a long call with the SPX, would that add delta? Yes, a long call with the SPX would add delta, no doubt. If that's too much, you could do something like the XSP. A long call on that would add delta. That add 1/10 of the amount of delta as the SPX. So those are all choices. You can look at individual stock positions, and that's what I want to look at here. Let's look at individual. Now, if I scroll down through the markets, let's scroll down through the S&P 500, you're going to find 90% of stocks are trending down right now. And I'm going to see this. I'm going to go and I'm going to throw on CVS, because this is one of the few stocks, to be honest, that is bullish. I'd say, generally we have a bullish trend on right now. Okay, but instead of buying the stock, we could certainly buy the stock. Instead of buying that stock, something we could do is we could do a synthetic. Okay. Since this is an options class, let's talk about that. Let's add a synthetic. What's a synthetic? I'm going to go long call, and I'm going to put on a short put at the same time. I'll do the same strike, okay? And that's what we'd call a long synthetic, okay? Long synthetic. I'm going to abbreviate synthetic, SYN, okay? Long synthetic. We call it a synthetic because it kind of mimics in some way stock ownership. It's not exactly the same. There's expiration dates, dividends are different. There's no dividends on this. And so, yeah, long synthetics is not stock ownership, but it's meant to kind of simulate it in a sense here. So let's do that. I've picked a stock that looks more bullish than a lot, just from the trend perspective. Doesn't mean it's going to go up. It may go down. But let's throw that in a portfolio here. By the way, if you wanted to add bearish with the short synthetic, you would go a long put and you do short call on that. That'd be a short synthetic. But in this case, let's do that long synthetic, okay? So let me go here. And I'm going to pick as much time as this is going to be a longer term position, okay? So I'm going to go out a half a year. I'm going to go out to September. I'm going to go basically, I'll go just in the money a little bit here. I'm going to buy the call, I'll go to the 67.50. I'm going to click on that call. I'm going to go to the 67.50 put. I'm going to sell that. I'm going to hold down my control key on my keyboard. And there we go. Now, if I look at this and I right click on this chart and I say, let's analyze that trade. And let me go to the risk profile, CVS. Do you see what that looks like? That risk profile looks like? Okay. So here's break even. Here's profits, profit up here. These are profits, great. These are losses down here below the break even. This is break even right here. Okay. What happens as the stock goes higher? We make money. Okay. The underlying stock goes higher, we make money. What happens as the underlying stock goes lower? We lose money. If I were to do this, and I were to say, hey, I'm going to trade just the long stock, and I'm not going to take the time to do this just because I want to be careful of time management. I have enough time here. But if I were to pull up a stock, it would look very, very similar. If I were to do 100 shares of CVS stock, it would look very, very similar to this setup that we have right now. Okay, very similar. That's why we call it a synthetic. What's a synthetic? A synthetic is like a substitute for something else. That's why they call it a synthetic. Although, as I mentioned, it's not an exact substitute for stock. So this is giving me a little more time. The theory is this is going to give time for a little bit of a longer term position. Because remember, when we were looking at SPX, we said, well, short term, there's not a lot to be bullish about. Longer term, though, I want to shift that portfolio a little bit there. Okay. Now, Ray said, why not add a long put for protection? I can certainly add, you could do that, right? We can certainly do that. And there are certain, let me go back. We were going to CVS. What would the long put for protection add to this? Well, it would add protection in case things go down, okay, no doubt. But it would also add in, just think about the overall consequences. And I'm not saying it's right or wrong, it's good or bad. It would add in negative theta to the trade if we were to add a long put, an extra long put onto that, or a long put onto that synthetic. Okay. It would also cost money. Okay, up front. This is going to the synthetic, because I'm buying and selling the same strike. The cost is going to be pretty minimal on it. They're going to largely cost. Now, maybe that's worth it to you to protect yourself on the downside. Absolutely. So if it is, you may consider that. So I think it's your thinking. Ray, good job. That's what we want. You can consider that. Okay. So let's do that. And what I'm going to do also on this is I'm going to say, here's CVS. I'm going to say, look, I'm bullish on, we're assuming this is bullish. We're assuming this trend is going to hold. But if we break down, and I'm going to call this kind of a support level right here, I'm going to put an exit on this trade here. I'm going to go, I want to give it a little wiggle room. I'm going to let it touch here, maybe even go here, but I'm going to go about, maybe a little bit below that, maybe about 3% below that level. 66 is going to, 3% is going to be about 64. So if the stock goes down here, then we'll look to exit. At that point, it's looking like it's going to be a lot less bullish on that. So I'm going to say at 64, we're going to look to exit this trade. All right. So here's my entry on this. I'm going to make this first trigger sequential order. I'm going to right click on this. I'm going to create an opposite order to get out. Okay. So there we go. And when are we going to get out? Well, we're going to make it as a market order. I'm going to make it good till canceled. I'm going to go to my gear and I'm going to say, I want to get out if CVS, click under symbol. Okay. And I'm going to mark, if CVS marks or price is less than or equal to $64, we're going to look to get out of that trade. Okay. And what we're also going to do is we're going to review this. We're going to click on confirm and send. Let me just look on this real quick. That's my mid price. That's my natural price. Confirm and send. And I'm going to put this why is that not letting me change groups? Okay, it doesn't matter. We'll just enter it anyway. Make sure you read through this. We're going to buy, let's call it a combo. It's costing us $151 total on that. Not a lot compared to with higher implied volatilities and whatnot. And we're going to sell if CVS marks at or below $64. So I'm going to add that trade in there. We just entered that. There we go. Oh, I know why it wouldn't let me put it in a group, because I had unsorted our groups here. That's why. That's why. Okay. Is that making sense here? I'm hoping. Now, what did we do to our delta? We actually shifted that delta. It was down about -1. We've now made it just a little bit positive in a small measure. Okay. Remember, if you want to have more impacts on it, you can do other things to that. If you, you can do index options if you want. You can just do long call SPXs, and would add a much bigger impact on that. But of course, if you have bigger impact on the upside, you have bigger impact on the downside too. So there's two sides to every trade here. Okay. Now, if you have any questions, let me just look. I know Scott's helping you out in questions there. I appreciate that, Scott. Thank you very much. Just a reminder, there is a survey link in the chat. And now, here's what I want to do. Okay. George said, should we adjust Vega and Theta? Should we adjust Vega and Theta? That's a good question. It's beyond the scope of what I'm going to go into today, George. And the reason is I want to leave some time for position management. I wanted to focus on the beta weighted delta as the main measure. You know, when we consider our Greeks that we have listed here, delta, theta, vega, the one that is probably the most impactful, typically, if we get big market moves, is that delta. I don't want to say theta is insignificant and vega is insignificant. I'm not going to say that. Right now, and if you want to make adjustments to these, you certainly can. If I want to adjust theta and make theta more positive, I can add on short positions. Okay, short options are typically going to give me more positive theta. My theta right now is moving again, is negative right now. Okay, and part of that is I have a lot of long options. I have a lot of long puts in there that is not helping my theta situation. I could take off that NVIDIA trade. That would help my theta out quite a bit. We can do that. Now, sometimes when you're doing these, not sometimes, it's always a little bit of a balancing act on this. It's kind of like, what's the story of, there's the dam or the dike and the boy is putting his fingers in the holes in the dike to cover up one, but another one, when you adjust one thing, you tend to adjust these others. So it can be a little tricky on that. But to George's point, it's really a wonderful point. You can think about all these things. If you think implied volatilities are going to go down, it may behoove you to lower your vega there as well on that. So short options would tend to help add in negative vega as well. It would tend to benefit those as well. But the one thing about short options is they also tend to they don't tend to affect the delta in as big a way there. So consider that, think about that, folks, but I think that's all I'm going to address on that today. Just this, before we get to managing, one last wrap up before we get to managing some existing positions. Look at your portfolio, consider where your portfolio is postured, consider your forecast, not just the short-term forecast, not just the next couple of weeks, and consider if those two are kind of matching up, and possibly consider some adjustments to that portfolio. All right? Okay, let's talk about some management. I'm not going to manage everything today, but I do want to point out some general money management portfolio options management. I have Intel here. What do I have in Intel? Intel, I have an Iron Condor on Intel. And Iron Condor has two vertical spreads, as a short call vertical, as a short put vertical. And when we're trading Iron Condors or short call verticals or short put verticals, really probably any short option and a lot of other options even, when we start to get within a week till expiration, approximately less than 10 days to expiration, and you can see that right here, we'll often look to exit that trade, okay, regardless of whether they're doing good or bad. Now, you may not have this days columns on yours. You can add that. You can go to the gear, click on customize, and you can customize your columns, okay? You can add days on. If you're an options trader, I find it helpful. 9 days till expiration, so I'm going to look to get out of these. Now, the current price is at 1930. Our strikes are our call strikes. So we're obviously doing very well on this because we're a long ways away from our call strikes. Our put strikes, not so hot. We are losing a little bit of money on the trade overall. We're losing about $30 or so on that trade overall. And that can get, we're a long ways from a max loss, but that can get a lot worse. And so I'm just going to kind of take our lumps, so to speak, and we're going to get out of this trade. So when you have an Iron Condor, sometimes it can be harder to get out of both sides at once. You can get out one side at a time. Sometimes it can be hard to get out at all. Well, we may see that on the call side because the price is very small on that. But let's go to the put side. I'm going to control click, highlight the puts. I'm going to right click. I'm going to create a closing order, and we're just going to get out of that. Okay. So I'm going to buy this back. It's at the mid price. I'll go halfway between mid and ask and just get out of that trade. Okay. So we're out of that. Now, so we got out of half of that, but we're not done, because what I'm going to do is I'm going to look to get out of this call side as well. I'm going to right click on this. I'm going to create this closing order. Now, do I have to get out of this? I don't have to get out of this. This is it seems unlikely that the stock is going to go above 26 between now and then. Remember, the stock's at 1930. Seems unlikely between now and 9 days from now we're going to go up there. So some traders may just elect to let this expire worthless and not pay the $2 to get out of this trade. But we're going to get out of it to be consistent with the rules that we follow in this class. I'm going to look to get out of that, and we'll see, and we filled that. Sometimes those can be a little tougher to get out of. I would suggest, though, that you consider when you have Iron Condors like that you get out of one side at a time. It tends to be a little bit easier to get out on those. Okay, let's look at another one. Let's look at CRM. CRM is actually doing very well on us. This is a butterfly spread, okay? This is a butterfly spread, and it's a balanced butterfly, equidistant between our legs here on this. You can usually tell butterflies when you have an uneven amount, a negative quantity there, and half the amount there and half the amount there. That's a butterfly. Our goal on the butterfly is for the stock to go, our target price on butterflies are for the stock to go to the mid price, 255. Where's the stock right now? 254, okay? So we got lucky in that one in a certain sense, in that we were forecasting kind of negative, and it's actually done very well. And you can see that reflected here. So this can certainly get better, but it's actually, there's a good chance, if our goal is for this to stay near 255, now we still have 23 days, so there's no huge urgency to get out of this trade. But if I go to CRM, I can type that right. If I go to CRM and say, where do we want this stock to be? I want this stock to be right here. Where is the stock? The stock is right here. What are the odds it stays in this range versus I'm going to take that money and run in this case. Okay. So we're going to look to exit that trade right now and capture a little profit in there. So I'm going to look to exit. Now I'm just going to cancel my CRM, excuse me, I'm going to cancel these orders, okay? And I'm going to look to get out. I'm going to highlight this. Now, again, I can get out one side at a time if I want to. I'm going to create that closing order on that butterfly, though. We don't have to get out of it all. And I'm just going to go down, see if we can get filled. We'll try and see if we can get filled like 1010 or so, okay? Why did I do that? Because the mid price, it's unlikely I'm probably going to get filled at the mid price, okay? I want to sell this for as much as I can, though. So I don't want to, I mean, it's pretty likely I'll get filled at the natural price, but it's changing. It's a moving target here on us. I should have clicked when I had a chance. But we'll see if we can get filled. And I want to get out of this if I can. Take our profit. We got our profit on CRM. Okay, let's do one more trade, one more management, and then we're going to call it a day. Because I want to point out something here. On UNP, this is one that we rolled last week. Okay, let's look at the history on this. When we entered this trade, we entered this on 3/25, okay, March 25th. We bought a 425, excuse me, not 425, a 245 put for $14. We rolled this, okay? We rolled this trade. And in the process, we brought in a credit. We bought this at $14.25. We sold it at $38.50. That's a $2,400 credit. Am I doing the math right there? Yeah, roughly a $2,400 credit we brought in. We rolled it down to a lower strike. And one of the reasons why, and if you're interested, I talked about this in much more detail last week. Just go to last week's session for this class. And I talked about the theory on this. We not only were able to bring in some money, we were also able to lower the delta because our delta was 80 something. I don't remember exactly what it was, but it was like 80, okay? And when you have a long put, which is what we had, a long put and an 80 delta, that's great. That means the trade has been going well in this case because we started with like a 60 delta. Technically, I should put a negative in front of those because it's the put. Started at like a negative 60 delta. That means things have been going pretty well, okay? But not only were we able to bring in a credit, but we actually are lowering the delta so that if it did go against us, which it did, UNP went up, and you can see that reflected in the PL open of that open trade. This is the trade we're in right now, that 225 put. That's getting hit, but it's not getting hit to the extent it would have been if we just stayed in that trade. Okay, so let me get out of here. We're looking back at this. So yeah, we brought in that 2,400 credit, but on the new trade, we're down $1,000 on this. The question is this, and this is how we're going to finish. The question is this: should we stay in the trade at this point? Well, what I would say is this: I have a long put. I don't have any stop or anything on that. Let's look to add in a stop on this probably if we're going to stay in it. Are we still bearish on UNP though? Here's UNP. UNP. Still bearish. I'm willing to say the trend is still down. We're still going to call this bearish. I'm going to say if we break above these highs here, say to 225, we're just going to get out of that trade. So I'm going to put in an exit order on this. We're going to stay with the trade because we're still bearish with it for the purposes of this class. And remember, all these trades are just example trades. I'm going to put on create a closing order. And what I'm going to do is I'm going to make that a market, good till canceled. And I'm going to click on my, what was it, 225? 225, we were going to get out at 225. And I was going to click on that gear. And we're going to exit this if UNP marks greater than or equal to 225. Okay. Confirm and send. Send. Okay. And now you can see with that tag, we have that exit order on that trade. Okay, folks, I am out of time, but let's quickly wrap what we did. Let's talk about what we did. We talked about beta, because beta is an essential concept if we're going to talk about beta weighting your delta. We talked about beta weighting your delta, making sure your portfolio matches your forecast. We talked about adjustments you can make to that. We added in a new trade, a synthetic, and we managed a few trades. It was a full session there, everybody. Thanks for joining me. Coming up next, we have trading price patterns. And so make sure you check that out. Along with the rest of our webcasts, we have, just make sure you subscribe to the Trader Talks webcast and make sure you fill out that survey link that Scott put in the chat. Thank you, Scott, for helping me out. Thanks each of you for spending some time with me today. And we'll see you all same time next week. Bye-bye, everybody.